Good evening,
Good evening,
sir.
sir. You
Yeah,
are loud and
Mr.
clear.
Pascal. All right. Tonight, we are starting a new topic. Of course, for some reasons, our class last week, we couldn't have our class. Because of the public holiday, we have several classes during the day. So management thought we should allow the student to rest, albeit we are looking at a new topic tonight. The topic is option theory and valuation. Now, this topic may be coming to some of us for the first time. The topic is treated at the final stage of your exam. Just 1 minute. All right, let's go on with the class. This topic is treated at the final stage of your exam. Option theory and valuation. Incidentally, this topic was the compulsory question last diet. For those that took the exam last diet, the examiner tested this topic as a compulsory question. For some of us, we are meeting the topic for the first time. And it is usual that if you are taking a topic for the first time, you are likely to come across some terms and terminologies that are strange. Please, let us exercise patience for learning. Knowledge is acquired through the process of consistency, perseverance, and patience. All right. What is option really? What is option market? Just as you have the stock market is a market where you buy and sell shares. We have the bond market. The bond market is a market where we trade in debt instruments, bond. We have the foreign currency market. The foreign currency market is a market where we buy and sell foreign currencies. An emerging market in the financial market is what we call the option market. The option market is a market where you can buy or you can sell options. Now the question is, what is option really? Option can be defined as the rights, but not the obligation to buy or sell an underlying asset at a pre-specified price. Within a specified period of time or on a particular future date. can be defined as the right. Somebody is conflicting our class. Please, if you have a question you want to ask, you can indicate by raising up your hand. Or you can also send a chat. All right, option theory now. Option can be defined as the right to buy or sell an underlying asset. Ufoma said network is breaking. Please, can somebody confirm that this communication is breaking?
Yes, sir, it's breaking.
Yes, sir. It is breaking. It is breaking.
Okay. Let's see. So I'm surprised. Okay, the network is unstable. The network is not stable. Now back to the business of the day. Option theory can be defined as the right to buy or sell an underlying asset at a pre-specified price within a specified period of time or on a future date or on a particular future date. When we say option, you are obtaining a right to buy an asset or obtaining a right to sell an asset at a price pre-agreed, at a pre-specified price, within a specified period, or on a particular future date. In recent times, the option market has emerged that allows investors to buy or sell options. You can buy options or sell options on underlying assets. The underlying assets could be stock, bond, currencies, commodities, and other financial indexes. The underlying assets could be stock. You can obtain a right to buy a company stock at a pre-agreed price within a specified future period. You can obtain the right to buy bond at a pre-specified price within a specified future period. At the same time, you can obtain a right to sell shares. Basically, there are two classes of options. We have the call option and the put option. The call option is the right to buy an asset at a pre-specified price. A call option. The call option gives the holder the right, but not the obligation, to buy an underlying asset at a pre-specified price, known as the exercise price, within a specified period of time or at a particular future date. So if you are obtaining a right to buy an asset, then you are talking of call option. The put option, on the other hand, this is the right to sell an underlying asset at a specified price within a specified future period. You can obtain a right to sell your assets at a future specified date at a pre-agreed price. If you are doing that, then you are obtaining a put option. Please note, you can either be dealing with call option or put option. Okay. Some terminologies associated with option. One is the option writer. The option writer is the seller of the option. That is the option market. The seller of the option is the option writer. To sell is otherwise known as the short. The option writer is known as the option seller. Number two, option holder. The option holder is the buyer of the option, also known as the long. The exercise price. This is the predetermined price at which the asset may be bought or sold. The exercise price. This is the predetermined price at which the asset may be bought or sold. So please note, you can obtain a right to sell your asset. If you are doing that, then you are dealing with put option. Or you can obtain a right to buy an asset. In that case, we are dealing with call option. Now, please also note, we have the option premium. What is the option premium? This is the amount of money paid by the option buyer and received by the option seller so as to engage in option transaction. Let's take that again. Option premium. Option premium is the money paid by the option buyer and received by the option seller so as to engage in option transaction. This is known as the market price of the option. So if you are trying to obtain a right to buy an asset, if you are trying to obtain a right to buy an asset, you are going to pay a premium for this right. Also, if you are trying to obtain a right to sell your asset at a future specified date, you are going to pay a premium to be able to obtain a right to sell your asset. This premium must be paid immediately. And this premium is not refundable. For any problem? Number next, American versus European options. You can have American option contracts. There are two types of option contracts. We have American option contracts and we have European option contracts. What is American option contracts? American option contracts, these are options that can be exercised at any time from the initiation of the option contracts up to the maturity of the option contract. American option contracts, these are option contracts that can be exercised at any time from the initiation of the option contracts up to the maturity of the option contracts. For example, if I obtain a right to buy First Bank shares, today is 8th of April. I can approach the option market today, 8th of April, to obtain a right to buy First Bank shares at a price agreed today within a specified period of 2 months. If I obtain a right to buy First Bank shares within a specified period of 2 months, under American option contracts, you can exercise your rights at any time between April 8th to June 8th, 2 months. Any time in between this period, you can exercise your right of purchase. But for European option contracts, this can only be exercised at maturity of the contract. Maturity will be at the end of 2 months. So please note the difference. All right. The concept of moneyness of option. Ooh. Before we explain this, before we go into the concept of moneyness of option, let us illustrate what we have discussed so far to further improve our understanding. Let us illustrate what we have discussed so far. Now let us assume that your company will pay you bonus every 6 months. Our company normally pay us half-year bonus. So let us assume you are expecting a bonus of 1 million naira. A bonus of 1 million naira is to be paid in just 1 minute. Now, please, let's go on. Let us assume that our company will pay us a bonus of 1 million naira in June. Half-year bonus. So I'm expecting 1 million naira in June. And that's okay. And I plan to invest this money in First Bank shares. My plan is that if I get this 1 million naira in June, I'm going to invest this money to buy First Bank shares. As of today, 8th of April, we know the price of First Bank shares at the stock market. If you go to the stock market today, we can know the price of First Bank shares. But what the price will be in 2 months' time, nobody is sure. We are not sure what First Bank shares price will be in 2 months' time. That is in June. Assuming 8th of June. We are not sure the price will be. And I want to buy these shares in June. You can approach the option market today to obtain a right to buy First Bank shares. You can approach the option market today to obtain a right to buy First Bank shares at a pre-agreed price today. But you are going to buy the shares in 2 months' time at a price pre-agreed today. The price pre-agreed today is what we call the exercise price. Now let us assume you agree to buy First Bank shares at a price of 100 naira per share. You have obtained a right to buy First Bank shares at a price of 100 naira per share. You now wait until 8th of June. When you receive your bonus in June, you now want to exercise your rights. When we get to 8th of June, we are going to know the actual stock price at the stock market. Now let us assume that on the 8th of June, First Bank shares is trading for 150 naira per share. On the 8th of June, First Bank shares are trading for 150 naira per share. And you have obtained a right to buy for 100 naira. Now the question to the class is, will you exercise your right to buy or not? The question to the class is yes.
Yes.
Omar.
We exercise our rights.
Good. Wellington said, yes, I will exercise my rights. I'm going to exercise my rights. I'm going to buy First Bank shares for 100 naira. What's currently worth 150 naira? In that case, you are going to exercise your rights because it is profitable to exercise your rights. You are going to buy First Bank shares at 100 naira. What's currently worth 150? That means you can buy for 100 naira and sell for 150. thereby making a profit of 50 naira. In that case, the option transaction is profitable. In that case, the option transaction is in the money. It is profitable to exercise your rights. That contract is in the money. Alternatively, assuming the price happens to be 75 naira per share, as at 8th of June, assuming First Bank shares are trading at 75 naira per share, but you have taken a right to buy First Bank shares at 100 naira per share. If you look at that scenario 2, if you exercise your rights, you are going to pay 100 naira for what? For a share that worth 75 naira. That means that transaction is not profitable. You are not going to exercise your rights. You are going to pull out of that transaction. Remember, it's an option to buy, not an obligation to buy. For the second scenario, the option contract is out of the money. It is not profitable. All right, any question, please? All right, let's move on with our explanation. The concept of moneyness of an option. Moneyness refers to whether the option is in the money or at the money or out of the money. In the money, what that simply means is that the option contract is profitable. It is better to exercise your rights. A call option is in the money when the price of the underlying assets at maturity is more than the exercise price. Like the example we gave, the asset price at maturity, the stock price at maturity is 150 naira. The exercise price is 100 naira. In this case, the asset price at maturity is more than the exercise price. The call option is in the money. It is profitable for the investor to exercise his right of purchase. On the other hand, a put option is in the money when the underlying asset price is less than the exercise price. Remember, put option is the right to sell. So if you are talking of in the money, it means that the option contract is profitable. Number 2, at the money. When the price of the underlying assets and the exercise price are the same, both the call option and the put option are at money. At that point is a break-even point where the investor neither makes profits nor incur loss at the money. Then the third one is out of the money. May we not be out of the money. Out of the money is a situation where the option contract is not profitable. It is not profitable to exercise your rights of purchase or sale. A call option is out of the money if the price of the underlying asset at maturity is less than the exercise price. Alternatively, a put option is out of the money if the price of the underlying asset is greater than the exercise price. At that point, it is not profitable for the investor to exercise his right to buy or his right to sell. Please feel free to ask your question, or you may drop chat on the chat group. Our next discussion, option payoff. The option payoff values. What is option payoff? Option payoff is the value of the option at maturity. The option payoff, this is the value of your option at expiration. At maturity, a call option is worth 0, or the differences between asset price at maturity and the exercise price, whichever is greater. We might need to illustrate this more. Call option payoff is denoted with the equation below. CT is equal to maximum of 0, or differences between asset price at maturity minus exercise price, whichever is greater. Where your CT, value of option at expiration. Your ST, value of the underlying asset at expiration. Your capital letter E, the exercise price. Please don't forget, the underlying assets could be stock or bond or foreign currencies. At expiration, a put option is worth 0, or the differences between the exercise price and the underlying asset price, whichever is higher. PT, that is the put value, is equal to maximum of 0, exercise price minus XT. This was part of the question last diet. The examiner says calculate the intrinsic value. Please note, the option payoff is the intrinsic value of the option. The above analysis is also called option intrinsic value. The intrinsic value, that is the value of the option at the maturity of the contract. The intrinsic value of the option is the value of the option at maturity. To calculate this your intrinsic value, you can calculate for put or for call option with the equation explained above. Prior to maturity, option will normally sell for more than its intrinsic value. The differences between the market price of an option and the intrinsic value of the option is called the time value. This was also tested. Examiner says, explain the characteristic of time value. The time value, otherwise known as the speculative value, that is the value, the differences between the market price of the option and the intrinsic value of the option. Note, the market value of an option, otherwise known as the premium payable, consists of two components. The market value of an option consists of two components. The intrinsic value, that is the value at maturity, and the time value. The intrinsic value and the time value. At all times, the market value of the option will be greater than the intrinsic value. At all times, the market value of the option will be greater than the intrinsic value of the option, except at the point of maturity, when the time value will become zero. At maturity, the time value will equal to zero. At this point, the market value of the option will equal to the intrinsic value of the option. We don't know what the examiner will text. Well, the examiner was bent on testing the last diet. Both compulsory question and optional question. The examiner was just loading option theory. May God give us a better understanding. Our next discussion, put, call, parity theory. Put, call, parity theory. This is the most fundamental parity relationship among option prices. This is the most fundamental parity relationship among option prices. This relationship shows that when certain conditions are met, there is a fixed relationship between the market price of a put option and the market price of a call option. For simplicity, this theory can be used to calculate the value of a call option or the value of the put option. If you know the value of a call option, then you can derive the value of a put option. Remember, call option, right to buy an asset. So if I'm trying to obtain a right to buy an asset, I'm going to pay a premium for this right. The premium payable is known as the value of the call option or the price of the call option. If you know the premium payable for call option, then you can determine the premium payable for put option. With the equation below, the fixed relationship is represented with the equation below. C plus capital letter E, the exponential sign, raised to power minus RT is equal to P plus X. Now, it is good to understand this formula, although the examiner will give you at the back of your answer script. But it is also good to understand how to apply this formula. Your letter C represents the call price or the call value. Your capital letter E represents the exercise price, that is the strike price. Your small letter R represents the risk-free rate. The time to maturity, that is your T. The P represents your put price, while your X represents the current stock price, that is the current asset price. Your stock is your asset. So if you have a stock, you can obtain option to sell, not obligation to sell. Now, what are the conditions? What are the conditions for call? For put call parity theory? Look at the conditions. 1, the call, and please, as much as possible, please read this principle up. Like last diet, most of the questions or some of the questions are in theory forms. The bottom line is for you to pass the exam. It is not mandatory for you to do calculation. If you pick all the theories and you're able to respond to the examiner, and the examiner gave you pass mark, that is all over. Now, what are these conditions? 1, the call and the put option must be on the same underlying assets. Number 2, the call and the put option must have the same exercise price. Number 3, the call and the put option must have the same maturity date. The expiration date must be the same. Number 4, the underlying assets must not pay dividends during the life of the option contract. Meaning that if you are obtaining a right to buy a stock, or you are obtaining a right to sell a stock, within that period of that option, the stock must not pay dividends. That is the conditions, or one of the conditions for put call parity theory. Number 5 condition, the call and the put option must be the European SI option. You can only use this theory to evaluate European option contracts. It cannot be used for American option contracts. Then lastly, the bond must be a zero coupon bond with a face value equal to the exercise price of the option. And with a maturity date identical to the option's maturity dates. Some of these conditions we apply when we are doing calculation. Our next discussion. The Black-Scholes option pricing model. Now, before I go to this, you may be required to value options. You may be required to determine the value of option, the price of option, maybe call option or put option. We have different valuation methods, or we have different valuation models. One of them is Black-Scholes option pricing model. We have the binomial pricing model. You have the mentor model. But currently, ICAN has been focusing on the Black-Scholes option pricing model. But please note, we also have the binomial model. So far, all questions have been texted on Black-Scholes model. Just today, we are likely to have new syllabus commencing in November. May God help us to pass and go. I have seen new syllabus for 8 years. We are waiting new syllabus for the professional class. And the new syllabus is likely to be effective November. So, what is the message here? As much as possible, try to pass and leave the stage. All right. The Black-Scholes option pricing model. This is a mathematical model. Black-Scholes model is a mathematical model that is used to determine the fair price or the theoretical value for call or a put option based on 5 variables. In other words, Black-Scholes developed a model using 5 variables to determine the price of a call option or the price of a put option. What are these variables? The 5 variables. One is the volatility underlying stock price, time to maturity, exercise price, and the risk-free rate of return. What are these variables? 1, underlying stock price. 2, exercise price. 3, time to maturity. 4, the risk-free rate of return. 5, volatility of the stock. Volatility refers to the risk of fluctuation. And please note, volatility is measured by standard deviation. The model estimates the variation over time of financial instruments such as stock. The Black-Scholes option pricing model. For call option, look at the formula, please. If you are to calculate value of a call option using Black-Scholes model, the formula is equal to, open a bracket, XO multiplied by N bracket D1, close your bracket, minus, open another bracket, capital letter E, exponential function, raised to power negative RT, multiplied by ND2, close your bracket. The put price, formula for put. Now, if you look at the way it is now adjusted. Here we start with capital letter E, exponential raised to power minus RT, multiplied by N into bracket minus D2. Close your brackets, minus, open another thing, SO minus N bracket minus D1. You are going to calculate your D1 and D2. To calculate your D1, the formula is in brackets XO divided by E. Close my brackets, plus, open another bracket, R plus 0.5 is constant in the formula, multiply by volatility square. Every divided by volatility square root of T. Your D2, to calculate your D2, you are going to get your D1 first. D1 minus volatility square root of T. Now let's define the variables. This P, that is the put price. C, that is the call price. XO, current stock price. Capital letter E, the exercise price. Your D1, value of the area under a normal distribution bell shape. The normal distribution table will be given to you. your small letter R, that is your risk-free rate of return. Our capital letter T, that is the time to expiration or time to maturity of the option, measured in fraction per year. Your standard deviation sign. This is the annualized standard deviation of the stock. That is your volatility. Please be careful. This volatility must be the standard deviation, not variance. We have defined the variables. We have defined the variables. We are waiting for the application of these variables. Okay. Fundamental assumption of Black School model. Please always remember, models are developed upon certain assumptions. What are the assumptions of the Black School model? One is constant volatility. It assumes that the risk is constant. Number two is interest rates constant and known. It assumes that the interest rates will remain constant and the interest rates are known. Number three is assumption that the underlying stock does not pay dividends during the life of the option. Last diet, examiner asked circumstances for the application of Black School option pricing model. Number next, it assumes a frictionless market. A frictionless market. A frictionless market is a financial market without transaction cost. That means at this market, you can buy and sell without incurring transaction cost. Then lastly, the model can only be used to value European options. This model is only designed for the valuation of European options. Any question, please? Any question, please? Okay. We round up this discussion tonight with the Greeks. The Greeks. The Greeks. This is the sensitivity of option value. to changes in the input variables. The Greeks measures the sensitivity of option price or option value to changes in any of the input variables. Remember the input variables in Black School model. The input variables are underlying asset price, the exercise price, risk-free rate of return, time to maturity, and volatility of the underlying assets. So the Greeks measure the sensitivity of option value to changes in any of the input variables. What we are trying to say is the stock price increases or decreases. That is the asset price. What is the impact on the option price? Assuming the risk-free rate changes, what is the impact on the option price? The Greeks measure how much the option price will change in response to change in one of these input variables. We have this type of Greeks. We have the delta. Number one is delta. Delta measures the sensitivity of option value to change in the price of the underlying assets. Delta is trying to measure the impact on the option price if there is a change in the asset price. The asset in this case is your stock. Your delta is calculated as change in option price divided by change in the underlying asset price. So what we are trying to calculate is, assuming the stock price increases or decreases, what is the impact on the option value? With Black School model, data can be approximated as follows. Please, you are going to memorize this. The delta of a call option is equal to ND1, N bracket D1. The delta of a put option is equal to N1 minus 1. The delta of an asset is 1. An asset could be a stock or a bond or a foreign currency. Delta neutral hedging. You can use your data as an hedging tool. When we say hedging, you can use data to protect your investments against fluctuation in value. If you are trying to protect your investment value against fluctuation, then you need to introduce the data. When they are neutral, data neutral position is one whose value does not change. in response to changes in the value of the underlying assets. A delta neutral position is a situation where the value of your investment will not change. In response to changes in the value of stock price. The objective of a delta neutral portfolio is to combine a position in assets with a position in option so that the value of the option does not change with changes in the value of the assets. The value of the portfolio does not change with changes in the value of the asset. Please note, to achieve a delta neutral position, your total delta must always give you 0. When we say delta neutral position, it's that position that will eliminate fluctuation in value. We are hoping to put calculation to this tonight. Other Greeks, we have gamma. Gamma measures the amount by which delta value changes as a result of changes in the price of the underlying assets. Gamma measures the amount by which the value of the delta changes when there is a change in the price of the underlying asset, calculated as change in delta value over change in underlying assets. Note, gamma is the same for both call and put option and is always positive. Next, theta. This measures the amount of change in asset price as a result of change in time to maturity. Theta measures the sensitivity of option value or price to a change in time to maturity. What that is saying is that assuming the maturity period is extended or is reduced, what is the impact on the option value? You have your RHO or RHO, RHO. This measures the sensitivity of option price to change in interest rates, the risk-free rate. Calculated as change in option price divided by change in risk-free rates. Real is positive for call option and negative for put option. Let me explain that. When we say real is positive for call option, it means that if interest rate is increasing, then value of call option will increase because it's positive. For real, if interest rate is increasing, value of your call option will also increase because there is a positive relationship. If interest rate is falling, value of your call option will also fall because there is a positive relationship between interest rates and value of call option, price of call option. But real is negative for put option. For put option, if interest rate is rising, value of put option will fall. Negative relationship. And if interest rate is falling, value of call option will rise. Lastly, we have the Vega. Vega measures the sensitivity of option price or option value to a change in the volatility of the underlying assets. Vega measures impact on your option price if there's a change in volatility. Vega is positive for both call and put option. So if you are trying to look at it, if the examiner says if there's increase in volatility, what is the impact on option value? Examiner must specify the option. If it is call option, if there's increase in volatility, then the price of call option will rise. If there's decrease in volatility, the price of call option will fall because there is a positive relationship between volatility and option value. All right. May God give us a better understanding of this explanation. We are done with the explanation. Any question, please? Now, please refer to your study pack where you have option theory. I'm not sure of the page now, really. I think page, please, somebody should check. I think page 140, 45 or 148, I'm not sure. Look at illustration 1. Let us address this question together. Please, can somebody check that study pack, your soft copy study pack? What page, please?
This does not look like 145. This looks like 145 is still financial statement analysis. So just check.
It's page 165.
Yeah.
Okay, page 165. Have you seen the question, please?
The company in Kano, yeah.
Okay, page 165, illustration 1. Please, let's try to open the question. Permit me just like 2 minutes. Let's open the question to page 165, illustration 1. You are the portfolio manager of an asset management company based in Kano. Your company has in its portfolio 27,750,000 shares of Yaro PSC, a company listed on the Nigerian Stock Exchange. That means our company, we have shares in another company. We have shares of 27,750,000 shares of Yaro PSC, a company listed on the Nigerian Stock Exchange. This trading 3 naira 60 kobo per share. Your shares in line to pay dividends. Our plan is that we are going to sell these shares in 6 months' time. And the money realized from the sales, we are going to use this money to pay dividends. As of today, the price of the share is naira 60 kobo. But we are selling in 6 months' time. We don't know the price yet. You plan to hedge the risk of Yaro's shares falling more than 5% from their current market value. We want to hedge to protect against falling more than 5%. That means you can tolerate 5%. It must not be 5% fall. Next paragraph. A decision has therefore been taken to buy an over-the-counter options to protect the shares. A merchant bank has offered to sell an appropriate 6-month options to your company for 1,250,000. That means somebody is willing to sell 6-month option to you, to give you a right, but you are going to pay a price of 1,250,000. Yaro shares has annual standard deviation of 13% and the risk-free rate of 4%. Requirements A. Evaluate whether or not the price at which the merchant bank is willing to sell the option is a fair price. Somebody is asking you to come and pay 1,250,000. Now the question is, this price, this asking price by the merchant bank, is this price a fair price? You want to give me 6-month option and you want me to pay 1,250,000. So want to evaluate if this price is a fair price. You can now ask yourself, from the discussion we have had so far, we can use Black-Scholes model. We say Black-Scholes model is a mathematical model that can be used to determine the fair price or the theoretical value. You know, if you understand the concept, you can apply it. Black-Scholes model is a model that can be used to determine the fair price or the theoretical value of a call or put option based on 5 input variables. That means For this question, I can use Black-Scholes model to determine the fair price the merchant bank should have charged us. I will now compare it with what the merchant bank is asking us to pay. I can use the Black-Scholes model to determine the fair price for this option. When I get my answer, I will now compare this fair price with the price being charged by the merchant bank. That will now tell me whether the price is fair or not. Please, for this option theory, you require normal distribution table. Let me share with the group first. For option theory, you require normal distribution table. Share with your group, with the group chat. Now let's go to this. Of course, look at this. Your company plans to sell the shares in 6 months. That means we need to obtain a right to be able to sell. In this case, this question is talking about put option. Put option is the right to sell. So this question is about put option. So we need to determine the type of option. Is it put option or call option? This question is talking about put option. We want to obtain a right to sell our shares in 6 months. Let's go to the solution together. Suggested solution. Please, as much as possible, we'll make this class to be participatory because the calculator itself, you might need to apply some function on your calculator. So I'm dealing with put option. So valuation of put option. Valuation of put options. Using Black-Scholes option pricing model. You state your formula. P is equal to, open a bracket, capital letter E, exponential, raised to power RT, then multiply by N, open small bracket, minus D2, minus D2, then close your brackets, minus, open another bracket, XO, multiply by N bracket minus D1. Close this bracket, bigger bracket. Your variables, where XO, this is the current stock price. If you look at the question, the current stock price is 3 naira 60 kobo. Then next, your E, this is the exercise price. The exercise price is, from this question, the company can tolerate 5% fall in price. So you are going to compute 5% of 3 naira 60 kobo and deduct it. Currently, the price is 3 naira 60 kobo. We can tolerate 5% reduction in price. In this case, the exercise price is calculated as 3 naira 60 kobo multiplied by 0.95. If you work that out, it's going to give you 3 naira 42 kobo. That means the companies can tolerate 5% reduction in price, but anything above 5%, we have to protect ourselves. So exercise price, that 3 naira 60 kobo you have, compute 5% and deduct it. Compute 5% and deduct it. Next, your small letter R, that is the risk-free rate. If you look at the question, this is giving us 4%. That is equal to 0.04. You can refer to the question. Look at it. The risk-free rate is 4%. Annual standard deviation, 13%. That is the volatility. Our standard deviation, which is equal to our volatility. Volatility is 13%, 0.13. Your capital letter T, that is the time to maturity. Examiner says 6 months. 6 months. We are planning to sell our shares in 6 months. So the time to maturity, we are going to exercise our right to sell in 6 months' time. You are going to prorate this because 12 months make a year. So this becomes 6 over 12, 0.5. You have stated the 5 input variables. You now introduce your D1 formula. D1 formula is given as in bracket XO divided by E, capital letter E. Close your brackets. Plus, open another bracket. Your R plus 0.5 is constant with this formula. Volatility square. Close your bracket divided by T. Multiply by T. Everything divided by volatility multiplied by square root of t. Once you state your 5 variables, then you can calculate D1 first. Look at the formula. You must know your D1 and D2. Our D1 becomes in bracket my XO 3.60 divided by my E 3.42. I will close my bracket. Plus, open another bracket. My small letter R 0.04 plus 0.5 multiplied by volatility 0.13 raised to power 2. Close my brackets. Multiply by time. Multiply by 0.5. Everything divided by 0.31 square root of 0.5. Now, please, let us take our calculator. On your calculator, you can only use scientific calculator here, please. You can only use scientific calculator for this. On your calculator, you are going to see the in. That is your natural log. Are we there with our calculator? Let us work with this together. Are we set, please?
Yes.
Yes, sir.
All right. Now start, press in. For some calculator, it comes with bracket. For some, you need to introduce the bracket yourself. If it's coming with bracket, no problem. But if it's not giving you bracket, then introduce brackets. 3.6 divided by 3.42.
.05129.
Don't get the answer. Don't worry. Just close it. Close the brackets. Now, plus, open another bracket. 0.04 plus 0.5 multiplied by 0.13 raised to power 2. Then close your brackets. Multiply by 0.5. You can get your answer. You are going to get 0.075518294. Obtain your answer for your numerator. What do we have, please? The numerator will give you 0.075518 plus. Then now do divided by. If you now want to divide, your denominator, you have two figures. So it's better to introduce brackets. 0.13 brackets divided by 0.13 multiplied by root of 0.5. Get your final answer. You are going to work towards 4 decimal places. Your final answer will give you 0.8215.
think I got
Your
something
D1
I
is,
got something slightly different. I'll just reconfirm.
it should be the bit
I got
0.8215.
I got 0.88. And let me just reconfirm.
There shouldn't be any difference, please. Your D1, taking 4 decimal places, you should have 0.8215. Now, please reconfirm you have this answer.
Yes, sir. I got the same thing.
Oh, that's great. That is your D1. Once you get your D1, then proceed to get your D2. Once you get your D1, then proceed to get your D2. Your D2 is D1 minus volatility square root of T.
I'm okay now.
That's fine. Your D2 is equal to 0.8215 minus 0.13 square root of 0.5. Now work this out. Your D2 will give you 0.7296. Zero point 7296. That is the value of your D2. Please confirm you have resolved this. It is good to participate in this in the classroom. Let's
Fine, it's
confirm
correct.
you are okay. Now, when you are done with your D1 and D2, your next computation is normal distribution value for D1, normal distribution value for D2. Your next working is, look at this, determine ND1 and ND2 using normal distribution table. Note, the normal distribution table comes with either 0.5 plus or 0.5 minus. I will have to explain this. Now you go to you want to get your ND1. you are going to use the figure for D1. Your D1 figure is 0.8215. In this case, please note, you are going to establish a range. If you look at this number, 0.8215, this number range between, it lies between 0.82 and 0.83. 0.8215 is between 0.82 and 0.83. It ranges between these two lines. So you are going to establish a range. You can now go to your D1 now. Now, we said normal distribution table comes with either 0.5 plus or 0.5 minus. When are you supposed to use 0.5 plus or 0.5 minus? Now, please listen to this very well. If your sign here, like what you have here, if you compute your D1 or your D2 and you have a positive sign, if you compute your D1 or your D2 and you have a positive sign, then you are going to start with 0.5 plus. You now open a bracket. But if the sign happens to be a negative sign, then you are going to start with 0.5 minus. For my D1, I have a positive sign, 0.8215. So I'm going to start with 0.5 plus. Now we are going to your normal distribution table. I have the table also on this question. I want to check 0.8 under 2. Let us look at let's look at the table together. Okay, look at the table here. This is the normal distribution table. This is our normal distribution table. Look at it. You have your values. Now, I'm interested in 0.8. Look at it, please. I have 0.8 here. I will now trace it to 2. Look at the figure here. This is 0.0, 0.8. This is 0. This is 1. This is 2. The figure here is 0.2939. You are going to pick that figure. 0.2939. So I've checked 0.8 traced to 2, it gives me 0.29. 0.39. You now introduce plus. Remember the figure we are trying to derive, to check. 0.8215. We have checked 0.82. We are left with 15. We have checked 0.82. We have left with 15. Introduce the 15 here. Just pick 0.15. That is the differential here. Pick the remainder. You have checked 0.82. You are left with 0.15. Then open another bracket. Now go and check 0.8 trace to 3 on your normal distribution log. What do we have?
2967.
Thank you.
0.2967.
That is the upper bound. 0.2967. 0.2967. That is the figure for 0.8 under 3. Now do minus the figure you get as your lower band. 0.2939. This will give you the figure for your normal distribution 1, ND1. Sum this out. (0.5) plus bracket 0.2939 plus 0.15 into bracket 0.2967 minus 0.2939. Sum your answer out. Your final answer. Your final answer should give you 0.7943. Your final answer should give you 0.7943. That is your normal distribution 1.
Okay, that is confirmed.
And now go to normal distribution 2. Normal distribution 2. This will come from your D2. Our D2 figure was 0.7296. Then establish a range.
And it's
This
positive.
number lies between 0.7 to 0.73. We can now do our ND2. This is equal to, the sign here, this is a positive sign, 0.7296. So I'm going to start with 0.5 plus. I will open a bracket. Now go and check the log. 0.7 trace to 2, under 2.
0.2642.
2642.
0.2642
42.
plus you are left with 96. Is that not?
Yes.
Then take it as 0.96. 0.96. Open your bracket. Go check 0.7 under 3.
2673.
0.2673.
0.2673 minus the figure you get at the lower band, 0.2642. That will give you your ND2 figure.
Is 0.7672.
Correct, 0.7672. 0.7672. That is normal distribution figure 2. That is normal distribution figure 2. Now let us look at the formula. The formula that was stated that I want to use. Look at the formula. I require n minus d1, n minus d2. I've gotten ND1, ND2. Now, because I'm required to value put options, I need to go a step again. I need to determine N bracket minus D1, N bracket minus D2. I'm only doing this step because I want to use put option formula. Now to do this, I'll come here. Your N bracket minus D1 is simply 1 minus NG1, which is equal to 1 minus 0.7943. Get your figure. Your N bracket minus D2 is simply 1 minus ND2, which is equal to 1 minus 0.7672. Get your figure. This will give you 0.2057.
0.2057.
This will give us 0. What?
0.2328.
All right.
0.2328. 2328. You can now return value of puts. Let's restate the formula. This is equal to capital letter E, small letter e, raised to power r root t, multiplied by n into bracket minus d2, close my bracket, minus xo, multiplied by n into bracket minus d1, close my bracket. That means value of the put option, the put is equal to capital letter E, 3.42 exponential minus small letter r, 0.04 multiplied by letter t, 0.5, then multiply by 0.2328, I will close my bracket for this. So sorry.
Are you talking to me? You're not going yet to make a finish class.
I'll close my bracket for this. Minus, open another bracket. SO 3.6 multiplied by 0.2057. Please apply your calculator. That letter E, that is the second function in. Look at your in icon on your calculator. If you look at the second function, on top you are going to see E exponential. Once you press E, any figure you apply is raised to power. Please work this out. So 3.42, go to second function or shift, then press your in. The letter E will come out. Then introduce your minus 0.04 multiplied by 0.2. Get your answer first. It will give you 3.352 plus. Then multiply by 0.2328. That will give you 0.7804 minus, open a bracket for the two figure, 3.6 multiplied by 0.2057. Your final answer should give you 0.03989.
988.
That not?
That is correct, yeah.
You are going to have value of a put is equal to 0.03989. This is the value of one put. How many shares do we have in this company? 27,750,000 shares. You can now calculate. Look at it. On the assumption that one share is equal to one put option. Total value of the put option is 27,750,000 shares multiplied by 0.03989. Please multiply. A final answer?
$1,106,095.
1 million.
106,965 or
Yeah.
966 approximately.
One million 106,947 approximately 9.8. So the value should be 1,106,947.5. This is the fair price. If you have to buy this option, this is the fair price you should pay. And merchant bank is quoting how much? The merchant bank
1.25.
Asking price is 1,250,000. You should have paid 1,106,000. Merchant bank say come and pay 1,250,000. Is the price quoted by the merchant bank, is it fair?
No.
The answer is no. Comment. The price quoted by the merchant bank for the put option is not a fair price. The bank is charging an additional price of 143,052.5, i.e. 1,250,000 minus 1,106,000 for 947.5. You are done with requirements A. Damna says, explain briefly, without any calculations, how a decrease in the value of each of the following variables is likely to change the value of a call option. So if there's a decrease, one, what are these variables? If there's a decrease in volatility, what will happen to the value of your call option? If there's a decrease in risk-free rates, what will happen to the value of your call option? What is the examiner texting here? The sensitivity of option value to change in any of the input variables. What is being tested here, please?
No fluctuations in his stock price.
What is being tested here? The examiner is trying to test the Greeks. Let us go to the first one. Examiner says, we explained Vega, if you recall. Vega, change in option value divided by, oh shit. Change in option value divided by change in volatility. So examiner is saying that if there is decrease in volatility, look at the question. Examiner is saying that assuming there's a decrease in your volatility, what is the impact on call option value? Look at it. Change in call option value divided by change in volatility. So if there's a decrease in volatility, volatility is falling. What is the impact on your call option value? Remember we said Vega is positive for both call and put option. Remember we explained that Vega is positive for both call and put option. That means if there's a decrease in volatility, then value of call option will fall, will also decrease. That will give you positive. The two will move in the same direction. Decrease in volatility will lead to decrease in value of the call option. So your comment here will be a decrease in volatility of stock will lead to reduction in the value of call option. That's all. That will give you your 2 marks. That's all. Then the second one, decrease in risk-free rate. What is the impact on option, call option value? What the examiner is texting is your RHO, RHO, calculated as change in option value divided by change in risk-free risk-free rates of interest. Now, we stated that real is positive for call. Real is positive for call option, and real is negative for put option. For put option. That means the data now says, assuming there's decrease in risk-free rates, what is the impact on call option value? And you have said real is positive for call. That means if there's a decrease in risk-free rate of interest, value of call option will also decrease because it must give me positive. Decrease in risk-free rate will result in decrease in value of the call option. The two of them must move in the same direction to achieve positive relationship. Your comment will now be a decrease in risk-free rates of interest will result in decrease in the value of call option. That is all. No calculation is required. It's just testing your understanding of the principle. Like I said, please, let us make time to read it. We may not like, let me be factual with us. It is natural that you may not know, you may not like some topic too well. It is for everybody. There are some topics that you understand very well, you love. There are some topics you struggle with. But because of the exam, you are going to try to learn the topics. At least have a reasonable understanding of the topic, so that you don't go to the exam and say, oh, this topic was tested. Oh. May God strengthen us. All right, we are done with this question. I think it's a time well spent.
Okay, I have a question.
Why not go ahead now?
No, the question I have is that this rho and vega, as it stands right now, I don't even know how to calculate it. I can see the formula, but I don't know what is it that they don't examine calculation of these? Because the first one for vega, we had change in option price divided by change in volatility. So when they say change in volatility, what do they mean by that? Is it difference between what the price is now and, if for instance there's a question to just put it into practice, except maybe they don't examine it in depth,
No,
it stops at this 1 mark or 2 marks.
It can be examined. Now look at it. Let's test with this question we have just solved. We are told that the volatility in this question, look at this question. We calculated puts here. Look at it. It's a good question you ask. So let me take you back to that. Yeah, good. For this question now, volatility is 13%. Can you see it? That is your risk. Assuming the examiner says the volatility increased to 15%. What is the impact on your option value? You know, you have gotten a value. Our option value was 0.03989. Is that not?
Yes.
Now, assuming examiner now says volatility increased by 15%, or it increased to 15%.
That's 2%. Okay.
From 13% to 15%. That means there is 2% increase in volatility. Now, what is the impact on your option value? That's okay. I will now go back and recompute. Look at it. So look at it. At 13%. At 13%, my option value was, the put option value was, come here. Okay. At a volatility of 13%, comma, put value is equal to 0.03989. Assuming volatility is now 15%. I will now guess what is the put value at 15%. If I now get that, I will have another value. Then I now need to look at change in value. Change in put value, put value, divided by change in volatility. I know this to be 2% change, 2. I will now get a new value. Assuming the new value I've gotten is 0.02954. I will now get what is the change in value over change in volatility. That will now give me the Vega. Is that explanation clear, please?
Yes. Yeah, very well. Thank you.
So they can text it too. If volatility should increase, we expect the put option value to fall. Okay, Vega is positive for both call and put option, so it's going to rise. If volatility should increase, value of your put option will also increase. If you go back, you can recompute this question. Now change the volatility to 15%. You are going to observe that this value will rise to above 0.39. The value will rise. We can now determine rise in value.
For this one now, on top, the change in put value will be with change in put value. We have at 13%. Okay, so this 10% is hypothetical, for instance. So the difference divided by the change in value. So difference between this and this divided by the difference between 13 and the other rate, right?
Yes. So examiner can text it too. All right. We call it a good evening from here. Let me take this off so that anybody looking at this is just explanation. If there's no question, you can have a good evening. We're almost done now. All right, good evening. Good night.